Then number 4, determination of purchase or sales price of PPE. Again, remember, in accordance with IAS, how do we call it? IFRS 5, held for sale and discontinued operation, when an entity derecognized an asset that is a PPE into a held for sale, from there it has to be recognized at lower of the carrying amount and the net realizable value. So probably at the end of the year, the price that the assets will sell for, we don't know. We are not in the known of it. But then it was after the reporting date that the entity was able to come up with, okay, this is how much we can sell this asset for. And so in accordance with IFRS 5, if that figure is lower than the carrying amount that we derecognize the PPE from to a held for sale, then it means we would have to again go there and charge an impairment in the P&L account. So it becomes what? An adjusting event. It becomes an adjusting event. Now, please don't get any ideas, because if the net realizable value, remember we discussed this last in the section 1, if the net realizable value is greater than the cost, it is not revaluation. The inventory or the asset in accordance with IFRS 5 will still be carried at what? The cost. It is not revaluation. So make sure you get that very well. And we established this also last week. So that is the issue about that. So these are a number of examples, okay, that I'm giving you here. It doesn't mean these are all, but these are a number of examples. So settlement of outstanding court case, IAS 37. Bankruptcy of a customer, prudence concept. Sale of inventory at below cost, IAS 2. Determination of purchase or sale price of PPE, IFRS 5, non-current asset held for sale and discontinued operation. So these things were not confirmed at the reporting date. So what do? We now confirm them after the reporting date. These are adjusting events. Because they are adjusting events, we have to go back to the financial statement and then amend the financial statement or adjust the financial statement. That is the idea about adjusting events. Any questions, you put it in the chat for us, or you put it in the comment section for us. I see some of you guys joining. You are welcome. This is IAS 8 and IAS 10 events after the reporting period that we are getting ourselves into. If there are any questions, don't hesitate. Put it in the chat for me. I'm going to be reading all your comments in a moment. So let's go. Non-adjusting events. If you remember, we said non-adjusting events, they don't really provide us with anything that confirms something at the reporting date. So fall in value of investments. Fall in value of investments, that one, it's not our problem. So for instance, we have shares in a company, and after the reporting date, something happens and the share price of the company falls. That's a non-adjusting event. We don't have to go back and adjust our financial statement. Major purchases of assets. If a company buys an asset after the reporting date, you don't go back and go and adjust your financial statement, because remember, after the reporting date, the asset had not been bought. So it was bought after the reporting date. So we cannot go back and recognize those assets in the year-ended financial statements. Announcing a discontinued operation. Again, that it wasn't in the reporting date. If it was something that the entity had been working on, they were thinking about it, then fine. But if after the reporting date that they announced it, then we cannot adjust, because remember, again, in accordance with IFRS 5, non-current asset held for sale and discontinued operation, non-current asset held for sale, discontinued operation, the entity can only recognize a held for sale or discontinued operation if the sale criteria is met. If the sale criteria is met. Now, what is the sale criteria? It means that management must have intention, or management must decide to sell the asset or discontinue the operation. To sell or discontinue. That is the first thing. So that's the first thing. Management must decide. Not only that, definitely the asset must be available for sale. So if at the reporting that the entity is still using the assets, then it's not available for sale. They must be looking for buyers, okay, or even negotiating with a buyer through advertisements, announcements, and those things. Then they expect that the sales will be taking place in less than 12 months. In less than 12 months. So the announcement is being done after the year end. That means the criteria for recognition of non-current asset held for sale and discontinued operation had not been met. So you cannot go back and adjust what? The financial statement, because you can only recognize held for sale and discontinued operation when we have met the criteria. Management has decided the asset is available, they are looking for buyers, the advertisement, or they have even found buyers, and then they expect that the sales will occur in less than 6 months. Then announcing a restructuring. Announcing a restructuring is also a non-adjusting event. Why? Because again, in accordance with IAS 37, provisions, contingent liabilities, contingent assets, an entity can only provide for restructuring costs when a certain criteria has been met. So stay with me, Kevin. So you see how the standards are interrelated. I'm in IAS 10, but look at the standards we're bringing up. We are talking about IAS 2, we are talking about IAS 16, we are talking about IFRS 5, we are talking about IAS 37. And that is what I keep on telling you, that the standards are interrelated. You don't learn them and say, oh, I've finished with the standards. They are connected. They are connected. So restructuring, in accordance with IAS 37, an entity can only provide for restructuring cost when, number one, there is a detailed plan. So management has a detailed plan for the restructuring. But not only that, the restructuring has been announced to the people who are expected to be affected. Okay? Announcement of the restructuring to the people to be affected. If this is there, management has a detailed plan, they have announced it, boom, IAS 37 says we can provide for restructuring cost. But look at the context of this question. They are making the announcement after the reporting date. So they may have a detailed plan about it at the reporting date, but they hadn't made the announcement as at the reporting date. The announcement was made after the reporting date. That is why it becomes a non-adjusting event. I hope you're getting the picture. That is why it becomes a non-adjusting event. Why? Because as at the reporting date, the criteria had not been met. That is the idea. That is the idea. So these are a couple of examples and how we justify whether they are going to be treated as adjusting events or non-adjusting events.